Hey Bowtie Nation, Joseph Hogue here with a tragic wake-up call for a lot of investors. There is no return without the risk.
There is no return without the risk.
It's a fact that a lot of new investors have never had to deal with, and even investors in the market for a few years, we've been spoiled with a stock market that only went up. But there is an unavoidable trade-off between risk and return, one we're just now starting to see come back in 2022 with multiple sell-offs in the last few months and some of those high-flying growth stocks down 20 and 30% or more over the last year. In this video, I'll explain why you cannot expect high returns without high risk and what happens if you deny that fact. I'll then show you the 7 highest return investments for 2022 if you're willing to take the risk, and reveal one of my favorite low-risk investments. We're getting started right now, but before we do, I've got to send that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. I want to get into our list, so I'll wait to explain why that risk-return trade-off is an unavoidable law of investing later, along with what happens if you try for that high return without the risk. Nation, do not miss that last part. If you think that you're investing in some high return investment with no risk, you will lose your money, and I'll show you why that is. I'm partnering with BlockFi for this video. It takes less than 5 minutes to open an account on BlockFi, and you can deposit directly from your bank. You'll earn interest up to 9% on your cryptocurrencies and can even apply for the first Bitcoin rewards card that pays cash back in Bitcoin. Click on the link I'll leave in the description and you'll get up to $250 in free Bitcoin when you open an account. Now, we're starting off with high yield bonds, and these might not be the highest return investments, but among that idea of the safety in bonds, they provide a solid kicker for return. High yield bonds are just debt borrowed by companies with a lower credit rating, anything under a BBB rating by the S&P or BAA by Moody's. So you see here, bonds are separated into 2 categories, investment grade and junk or high yield, depending on that rating. Now, those ratings are based on a company's financial statements, how much debt they owe, and their ability to pay. And I hate that high yield segment is called junk because it's really not. The default rate on high yield bonds is higher than those in the investment grade area, but it's still under a 1% or about 1 bond out of 100 that doesn't get paid back. So the risk here is actually pretty low, but you get that extra return above what you'd get on other bonds. And the best way to invest in high yield bonds is through an ETF like the iShares High Yield Corporate, ticker HYG, which pays a 4.4% dividend yield and has beaten the corporate bond index by 6% over the last year. Next here on our scale of risk and return investments is stocks of companies based in emerging market countries, especially China. Emerging market stocks are riskier because the countries might not have the same rule of law or the business environment you find in North America or Europe. Institutions like the central bank and the judiciary are just less independent, so you've got a lot of economic as well as policy risk. But when these stocks work, they really run. Shares of the iShares MSCI Emerging Markets ETF, that's ticker EEM, jumped 323% in the 4 years to 2007 and 60% in the 2 years to 2018, easily beating the stocks in the S&P 500. Now, that fund was down about 10% last year on a stronger dollar, but trades for just 18.8 times on a price to earnings basis. That's a discount of 17% on the 23 times PE ratio for US stocks. And of course, right now, Chinese stocks have been slammed by that government intervention and the risk of being delisted from the US markets. Shares of Alibaba, ticker BABA, are down 62% from its peak last year. It's a great company with an advantage in e-commerce and trading at a steep discount, but the risk is there to more losses. So here, China is really a case study in those risks to emerging market stocks. The risk of government interference or those geopolitical issues between 2 countries hit the stocks. For investors willing to take the risk, though, you can get some great returns on a rebound. Options investing is one of my favorite high return investments, but it can also be a way to lower your risk. Options are just another type of investment you can make in stocks. With an option, you get the right to buy or sell shares of a stock for a certain price from now until the option expires. For example, here we have the options for Apple that expire in July of this year, about 5 months from now. And you can see that there are options available for every month and even ones out as far as 2 years. Here down the middle, you see the strike price. Now that's the price you're locking in for shares of Apple. So with this first row on the left side where it says calls, you can lock in a price of $120 for Apple. You can buy Apple for $120 each. But notice where it says last. That's the price that you pay for this option. You pay that $22.50 each just for that right to buy Apple shares at $120 anytime from now to that expiration in July. And here's where we see the idea of leverage that can really boost your returns. If the actual share price of Apple increases by 10% from $136 each to $150, so a gain of about $14 a share, then that option's price is going to go up by about that much as well. Instead of the option being worth $22.50 for each share, it's now going to be worth around $36.50 each. So instead of the gain of 10% you would have gotten with the shares, you got a gain of 62% on that options contract. That was just a quick and dirty on those options basics, and don't feel bad if you're still a little confused. I actually created an options 101 video a few months ago and a step-by-step including every strategy I use. So I'll link that in the video description below, so make sure you check that out. Like each of these investments though, I want to make sure you understand the risks. With options, you are risking that entire investment. This isn't like stocks where if shares of Apple fall 10%, you've still got those shares and are ready for a rebound. Once those call options expire, if shares of Apple haven't increased, you're out all that money. So you're taking much more risk on that higher return. Fourth on our list of high return investments, penny stocks. And here we're getting into that really high potential returns. I'm using the iShares Microcap ETF, ticker IWC. That's a fund holding 1,000 of the smallest companies in the Russell 3000 index as a proxy here, with a 16% annualized return on those small cap stocks. The real power, though, in penny stocks comes from finding those individual companies under $500 million market cap that are ready to run. Just here on the channel, we've got a 64% average return on the penny stocks recommended, with 9 that have more than doubled over the last year and 1 that's up 500%. But just looking at that penny stock list and the fact that 40%, about 4 in 10, are lower, brings up an important idea in your investing strategy. A nation, too many investors want to trade penny stocks, selling after a quick profit of maybe 40 or 50%. The problem is, though, investors tend to sell those winners way too fast to book that quick return, but then they hold on to their losers. It saps their total return and the portfolio just goes nowhere. Instead, I want you to take a venture capital approach to your penny stocks. In the VC world, where I worked for over 5 years, you're finding those startups with the triple-digit growth and then holding on until they get acquired or issue shares in the market. You might be locked into that stock for 3 or even 5 years or more, but the reward can be 10 times your investment and even higher. In penny stocks, this means building a portfolio of at least 5 or 10 stocks, small startup companies that could be big someday. Then you're going to give these stocks at least 3 to 5 years, holding them no matter what. Yeah, you're going to see some of those stocks, maybe even half of those stocks go nowhere, or even lower in that period, but by holding on to those winners and giving them time to grow into those 10x returns, your overall portfolio return can be as high as 20 or 30% on that annual basis. We've still got 3 more high-risk, high-return investments to show you, but I want to reveal why that trade-off between risk and return is so unbreakable. Why, even though stocks seem to have that one-way ticket higher, you still need to understand the relationship between that risk and return. The risk-return trade-off just means that investments with the higher potential for returns tend to have the greater risk, and prices tend to rise and fall more than the other investments. Of course, cryptocurrency is really the best example here. The price of Ethereum was up 400% last year, but investors had to stomach through crashes of 30 and 60% throughout the year. And this chart will help explain it. Those money market funds and the safe bonds produce low but safe returns, attracting investors with very low risk tolerance. There are fewer investors willing to take as much risk as you get in those emerging market stocks, though, so prices have to adjust for higher returns to attract those buyers. And that's why this trade-off is really set in stone. Investments adjust nearly immediately for levels of risk and potential return. And just think of the last time you saw a major news event break about one of your stocks. The price adjusted in a heartbeat, didn't it? And the market automatically adjusts to perceived levels of risk to drive that stock price higher or lower. We're counting down the highest return investments, and next on our list is startup investing and equity crowdfunding with a 27% annual return. Now again, this was my life as a venture capital analyst, and I saw investors book some massive returns. Startup investing is pooling your money with VC firms or an angel investor groups to invest in early stage companies before they issue shares on the stock market. A study by Willamette University of nearly 3,000 early stage investments found investors booked an annualized 27% return on their money over any 3.5-year period. That's 2.6 times your money in less than 4 years. Now, this is a high risk, high return investment though, and more than half of those new startups are likely to return less than your original investment. What you do though, you invest across a portfolio of 5 or 10 or even 15 companies, and you can have a few that blow the doors off on the returns with 10 and 20 times your investment. It used to be that only rich investors with over $1 million net worth could invest in these, but thanks to the Jobs Act of 2012, anyone can invest through equity crowdfunding platforms like Republic or AngelList. Now, this isn't like picking stocks though. The risk is that there's less analysis on these startup companies by investors, so you're going to have to do a lot of your own research. That means looking through the financial statements, analyzing the product and the market, and making sure management has what it takes to take that business to success. We've still got that highest return investment left to highlight, but the question is really, why is it important to understand this risk-return trade-off? And the truth is because I think a lot of YouTube channels are pitching those returns without the risk. They sell you into those high return investments without talking about the risks, just like Bernie Madoff did for more than a decade. You see here the chart Madoff showed his clients for nearly 20 years. His Fairfield fund is in the dark blue, producing those returns with almost no risk, even as stocks in the S&P 100 rose and fell. But it was all a scam. Investors lost over $50 billion on the lesson that there is no return without the risk, and that's what you need to understand. Not that you can't invest in these high return investments, but you always need to look for and understand the risks. Next here is an investment I've made a lot of money on lately: Bitcoin and other cryptocurrencies. I've got just over $500,000 in 5 cryptocurrencies on 2 different platforms, with the majority on BlockFi so I can earn that interest while I hold. Bitcoin was up more than 74% last year, even after the sell-off, and Ethereum, where I have most of my crypto, was up 300% over the year. Now, I do not want to imply that you can make 100% on your money every year, but this is a new asset class. It's not going away, and there is no doubt in my mind it will beat stocks for those returns. We've got a lot of crypto videos here on the channel, including their true value and how to invest, but I want to get you started here. It takes less than 5 minutes to open an account on BlockFi with just a phone number and an email address. You'll want to set up your 2-factor authentication to keep your account secure. You can buy crypto in any amount, and I'd recommend buying some Bitcoin, Ethereum, and a few of those smaller altcoins to diversify your portfolio. In fact, I recently shared the 5 cryptocurrencies I'm buying and my own portfolio in a video about how much you'd need to invest to become a millionaire, so look for that in the description below. One more high return investment before I reveal my favorite low risk moneymaker: starting your own cash flow business. And I know this is mostly an investing channel and you want to hear about stocks, but honestly, nation, the highest return you will ever get is through your own business. You can start an online business on next to nothing. I started 3 websites in 2014, spending less than $500 to get everything up. In 7 years, I've booked over $1.1 million in sales against less than $2,000 a month in expenses. That's a return in the hundreds of %. Now, of course, that's not counting the time I put in to run the business, so those triple-digit returns don't come without a cost, but you'll never find a better investment return than creating your own assets. Now, the risk here is more of that business risk, that you spend your time and money without the eventual cash flow. The best part about those online businesses, though, is that it takes very little to start, and you can manage these on 5 or 10 hours a week to start. I want to get to our lower risk investment, but I'll link to some videos below to getting your own online business started. Now, you've got those 7 high risk, high return investments, but I wanted to share one more, a decidedly low risk, high return investment, earning up to 9% interest on stablecoins. There is a huge demand for stablecoins right now from money managers, institutional funds, and banks. Now, stablecoins are just a type of cryptocurrency that locks its value to the US dollar. It does this by holding a reserve of dollars, so the price of that stablecoin stays at a constant value of $1 each. For example, the USD coin or USDC is a stablecoin backed dollar for dollar in a vault account. And now, to a money nerd like myself, the way these are being used in business and finance is like watching fireworks on the 4th of July. Because of the speed and the low cost transactions, stablecoins are being used in international money transfers, managed contracts, and even in arbitrage trading. So all this has just created a huge demand in stablecoins lending, and the cryptocurrency platforms are able to offer interest rates on your deposits that sometimes are as much as 100 times what you get on a bank savings account. Now, I'm going to show you those rates, and this is really something you have to see. You open an account just like any online bank account, transfer your money and keep it in stablecoins, and you're going to earn interest, that high yield interest, every day it's in there. And here you see those interest rates offered on the BlockFi platform, the one I use. I use the platform to earn interest on my Bitcoin and Ethereum, but if you scroll down, you see the rates offered on stablecoins like the USDC, Gemini, USD Pax, and the USDT. Interest rates as high as 9% on your money. Click on the video to the right for the 5 best investments for 2022, 5 ways to invest your money, and the 5 investments to avoid this year. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.